If you want to get richer, you have to make your money grow faster than inflation. Since the prices are always growing up, you have to find a way to get more. Thus, your objective will be to know how to beat inflation with your investments. While inflation has been desperately low for a long time, it looks now like it's set to rebound. Inflation has hit a low point in most of the major countries, especially the United States, where the decline in inflation was caused by temporary factors such as the drop in telephone prices in March, which will soon result in a favorable base effect. The upward trend of inflation could continue within the main economy. Japan and China are not to be outdone in this buoyant environment, giving growth a very homogeneous trend. Finally, in the United States, rising wages, deregulation measures, and plans for tax reform by the Trump administration could amplify the rise in prices. In the face of expected return of inflation around the world, the capitalist system has enormous advantages. However, with economic growth, your shopping basket and your cost of living increases every year. You're probably familiar with the term inflation. Historically, this inflation rate has been close to 3% a year for several decades. In other words, the value of your money is reduced by 3% every year. To avoid this loss, you need to be able to beat inflation with your money. How to calculate the inflation rate? Quickly, Canada produces an index to assess the change in prices of different products you consume: food, lodging, furniture, clothes, transport, healthcare, hobbies, alcohol, and tobacco. With all these price changes and based on the percentages associated with all these categories, we can estimate the potential rate of inflation in a country. In recent years, the inflation rate has been in the range of 2%. So how to beat the inflation with your financial investments? As you just seen, you're losing 3% a year of your net worth. If you have any interest to enrich yourself, you must produce returns with your investment. Indeed, it's with your investment that you'll be able to fight inflation, but unfortunately, the options are few: stocks, bonds, and fixed income, real estate, gold. Let's look at the different asset classes and the responses to inflation. Number one, and beat inflation with stocks. Before we tap into that, please let me know in the comments below what your thoughts are on inflation. What are the gas prices where you're located now? Hit the like button, sub button, bell button. Back to how we can beat inflation with stocks. Here are the best ways to successfully multiply your money and beat the rate of inflation. While you buy stocks, you become a public company owner. Therefore, you're entitled to a share of its profits and list in these companies. Historically, buying stocks offers investors a good guarantee against the erosion of the value of the assets leading to inflation. It is believed that the bank stock should be favored, with inflation pushing up long-term interest rates, allowing financial institutions to rebuild their margin. You may be interested in clinical stocks, showing reasonable valuation levels, as well as emerging market equities. An increase in emerging markets is consistent with the scenario of reflation. The ongoing improvement of consumption of emerging countries drives global growth in commodity prices. The strength of the stock market is as follows. Businesses can quickly adjust to the economic environment and steadily increase their prices and therefore their profits. Did you know that the stock market produces returns in the range of 8 to 10% a year? With that kind of return, you'll beat inflation and get richer. You can obviously participate in the stock market with the purchase of mutual funds and exchange traded funds, ETFs. All these things ensure that your investments will be clearly protected against inflation for a long time. Number two, beat inflation with fixed income. The news is pretty bad. With financial products like bonds and guaranteed investment certificates, GICs, you're going to have a hard time beating inflation. Interest rates are very low right now, and after paying tax on your investments, you don't have enough money to beat inflation and get rich. For bonds, the historical yield of the classic asset is around 4 to 5% a year. Obviously, in recent years, the expected return is even lower, with 2 to 3% year maximum. After again, your taxes and chances of beating inflation are slim. A final option exists with the financial products on the exempt market. You can expect returns higher than 5 to 6% a year. However, these kinds of investment are aimed at a small portion of the population. You should use them with caution. With all this information, you realize that overexposing your portfolio to bonds will result in you being more exposed to the risk of inflation and impacts of your wealth and financial health. Make the difference between preserving your capital and guaranteed capital. They are not synonyms. 3, beat inflation with real estate. You've probably heard this maxim before. Real estate is a safe investment. We invested in stone. Investing in real estate is going to take more effort than buying financial products. However, this has some additional advantages. A portion of your investment is like a fixed income with your rent. benefit from the power of capitalization. There are tax benefits like depreciation. In addition, you have a good chance of beating inflation with real estate since your assets provides minimum returns along with the inflation curve. And if you add your mortgage repayment or rent, your return will be higher. Obviously, it's more active than an investment. You have to find real estate deals, manage operations, and ensure minimum of management. Remember, your time is worth your money. Number 4, beat inflation with gold. You probably heard that gold is the best protection for keeping your money's value. The yellow metal constitutes a historic protective asset against inflation. Analyze Francois de Lassise, who reports that since 1900, all major currencies, such as the dollar, the yen, the euro, and even the British pound, ended up seeing their value collapse against that of gold. An essential investment of medium with a diversified heritage, gold is a real store of value claimed by centralized banks in the 2008 crisis. Indeed, over the period, the Federal Reserve Fed Bank of the French, German, and Italian power stations maintain the reserves, while those of emerging countries such as China, Russia, and Turkey increase their stocks. Of course, if the Fed were to raise the key rate too sharply in the face of the surge of inflation, the price of an ounce of gold could experience some turbulence. But over time, it should benefit from a lasting inflammatory environment. At the image of the career in 1970s, when its price had been multiplied by nearly 15, we can be exposed to the yellow metal via physical metal coins, ingots, or the gold bullion indexation of certificate of securities, which replicates the ounce step by step without hedging against currency risk. Investors willing to great vitality may look to gold mining funds such as Share Gold, Amudi, BGF World Gold. These stocks are all more interesting as they are inexpensive historically as a Visa gold. It should represent 3% of a financial portfolio. So gold is a safe haven for the majority of investors, and yet in the long run, gold is not going to provide you the returns that can beat inflation. In the very long, it even does a little less. Look at ETF investing in gold, XGD, and you will see that you haven't increased your buying power that much over time. Gold can give you a good return in the short term depending on the fears and worries of the market, but in the long term, it's not a set asset to own, in my opinion, to protect you from inflation. Other notable mentions to include other raw materials, especially industrial metals and energy compartment on the context of reflation, which is a resumption of inflation growth, encourages interest in commodities, which have the advantage of being real, tangible assets and whose prices traditionally benefit from strengthening of growth. Synonymous with increased demand, the prices of industrial metals are driven by the booming consumption of companies, whilst those energy is driven by developed countries. To take advantage of the good momentum in energy prices, the company placed itself on ETFs, energy trackers, which replicates the Bloomberg Energy Index, a basket made up of features of contracts on Brent, WTI, heating oil, unleaded gasoline, and natural gas. To take advantage of that industrial metals, it opted for ETFs, industrial metal trackers, which reflects the performance of Bloomberg Industrial Metals Index, a basket made up of features of contracts of copper, aluminum, zinc, and nickel. We recommend that you bet on the continuation of a trend. It remains bullish in the medium term. It's also possible to take advantage of the rise in industrial metal prices via mining stocks such as BGF World Mining. Works of art and great wines. Interesting as long as you know how to choose. Among other real assets, the tracking of works of art and great names and wine is interesting because these supports that offer effectively bulwark against inflation over long term. However, they're not within the reach of all stock exchanges, are rather intended for sophisticated or well-advised investors. Thank you for sticking around to the end of this video. I hope you learned a thing or two and of course enjoyed it. If you want to see more content like this, hit the like button, sub button, bell button, and also in the comments below, let us know what you plan on investing on.